Stuart, you just heard Jared, they're talking about cyclicals coming in fits and starts here. And you are looking sort of globally at cyclicals. How do you think that performance is going to shake out in the coming months?
Yeah, it's a great question. I think it gets back to this rotation theme that the previous guest discussed. Our view is amongst the rotation sort of trades, it's cyclicals or growth sensitives that we have the most confidence in terms of that being a sustainable rally. Just in the sense that the vaccine efficacy and the easy comparables on growth in 2021 should be really positive for growth expectations. So we do like in the U.S. being long what we will call high quality cyclicals. So kind of narrowing the investment universe to high quality stocks, but amongst that group, picking the most growth sensitive you can find. Globally, emerging markets is an area that we're pretty positive into next year. Japanese equities, so the Nikkei is another area we're pretty positive into next year. So we do see an opportunity in those cyclical stocks. We're much more positive towards those than we are to kind of lower quality or deep value stocks, in the sense that, kind of to my comments before, I think we're more comfortable that investors are seeing an improving growth outlook than we are that they are getting really comfortable owning kind of a lower quality, higher volatility stock. So we're bullish on cyclicals. We just think you want to be a little bit selective in terms of how you invest in them at this point.
Stuart, if we were not to get a stimulus plan this month, do you think that would be correction worthy for the broader market?
I don't think that would be a huge negative if we don't get it the next month. Just in the sense that post the election, I think most investors coalesced around the idea that the GOP was going to control the Senate and that it was going to be a heavy lift to get another stimulus package through before the end of the year. Now that we're also then waiting for the Georgia runoff, I think that's also tamped down expectations a little bit, in the sense that Republicans can sort of wait and see. If they win that runoff, then they sort of, control the discussion. If they lose that runoff, then the Democrats are going to push the stimulus through after that. So I think if I had to handicap it, I think at best investors were maybe hoping for $500 billion before year end. But I think the understanding was that was going to be a little bit hard to push through. So will you get a bit of a pullback? Yeah, I think you could get a modest pullback. Is this something that's going to be 5 or 10%? I don't think it would be that large, just based on where expectations are and where I think kind of the consensus view is at the moment.
And Stuart, I'd love to wrap up talking about maybe some more macro trades that you're seeing out there, hedges outside of equities, areas that investors are favoring. Obviously, it's been a huge year for gold. I would imagine you're getting some questions about what's happening over in the crypto space as well. What are you seeing, kind of more broadly across asset classes?
Yeah, I think, look, last week was quite an interesting one because equity volatilities declined, but all the commodities volatilities rose. So I think that's been a talking point in terms of what's going to happen to the gold trade and what's going on in the oil space. That said, I think the most popular discussion recently has been credit risk versus equity risk, and how do investors sort of trade that. Credit spreads are very, very tight right now. The idea that the Fed might not be as supportive of the credit market if the deal between Treasury and the Fed kind of breaks down, or sunsets at year end. So I think that's the one that's probably gotten the most attention in the near term in terms of, should credit risk be priced more aggressively? And if so, is there a spillover? If we do see some disruption in the credit market, does that kind of move over to equities? So our view is that is a risk. Our credit strategists do think you might get a pickup or a rise in credit spreads, in the first quarter of next year. And that could be a little bit of a headwind. So that's something we're definitely keeping an eye on. Gold, I don't really have a strong view there other than to say I think there is some growing concern that the bull market in gold is facing some challenges into early next year as well. So I think this is the big question of, do these asset classes continue to impact one another, or as we get into next year with accelerating growth, are those assets sort of able to behave independently of one another? Our view would be we are still in a fairly high risk macro environment, and that if you do have disruptions in commodity and credit spreads, that those are going to be impactful to equities. And at bare minimum, those are things you need to watch. And, perhaps you also want to be hedging those. The most popular way we've seen that happening is small cap, which is actually quite interesting because that's the index that's rallied so much in the last month. But from a credit investor's perspective, that's also the one that's most exposed to credit risk. So from a cross-asset perspective, I think credit versus equity is the focal point, and small caps would be the index that would be most exposed in both directions to that.
Very interesting stuff. Thank you so much, Stuart. Appreciate it.